Hey everyone, we got some big news out of Tesla. Reportedly, Reuters saying that Tesla has told production workers that they will get a pay hike in the United States. So, in this video, I'm going to review what that could mean for Tesla stock investors and for Tesla's business overall. So, let's jump right into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So here you have the news out of Reuters saying that Tesla told production workers that they will get a pay hike according to Bloomberg News. And Tesla's stock price is down 3% on this day of the announcement as of this recording, which the stock price drop is a little surprising to me because as soon as Ford and GM and the other unionized auto companies reported their agreement with the unions, investors, I think, should have known that Tesla was going to have to raise wages to be competitive. Otherwise, they would risk losing a lot of their workers. Now, you can see that the UAW deal, for most UAW workers, they'll receive a 25% wage hike, beginning with an 11% increase during the first year. They will also get lump sum payments of $9,000 to ratify the deal and $1,500 annual inflation protection payments. So that was a big increase in wages for UAW members. And if Tesla didn't raise their wages, they would risk losing a lot of their workers over to UAW supported companies. And so they were in a position that they had to increase wages. That was expected. I was reporting on that as soon as that news came out. I was highlighting that Tesla is going to soon have to follow and offer wage increases of their own. Now, where is this going to hurt Tesla? Well, you can see their operating profit margin over the trailing 12 months has fallen to 11.22%. This is down from a closer to 20% operating profit margin at their peak. Still, you can see Tesla has done an excellent job of increasing their operating profit margin over time. Even with this decrease, you can see that upward trend over the last 5 years working nicely, even though there's been some choppiness. Although this isn't the only thing that's going to hurt Tesla's operating profit margin. The other thing that I'm sure all Tesla stock investors already are tired of hearing about is the price cuts. Tesla cut prices in the US and around the world multiple times during 2023, at times by almost 20,000 on some of the higher priced models. Even lower priced models, rear wheel drive, saw price cuts of at least $6,600. Industry analysts expect that this is going to hurt Tesla's profit margins when it reports earnings on January 24. And I agree with that statement. When Tesla reports its earnings on the next update, I think its profit margins are going to move even lower from here. Now, you might say, well, how is the Tesla truck going to impact profitability? Initially, it's going to hurt profitability. It takes time to ramp up production to a scale high enough to generate profitability on a new product. And Elon Musk has often said that it's going to take a while before the Tesla Cybertruck becomes profitable. Also, the prediction of or the maximum units produced in 2024 will be around 125,000 units. So it will not be enough to be at a scale that will generate profitability. So that's another product that's going to hurt Tesla's profit margin. Tesla's price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that you've got a little more information on what the price to earnings ratio measures, you can see Tesla's price to earnings ratio forward at 42.44. This is near the lowest this stock has traded for, going back all the way to early 2021. Briefly, around the end of 2022, you were able to get Tesla stock at a cheaper valuation. And it's ironic that here, beginning 2024, again around January, just like last year, we're seeing Tesla's valuation drop. But is it going to be like the year before, where following this drop to start the year, Tesla stock rebounds and moves back higher? That's going to be interesting to see if that happens. Now, 2023 was an interesting year for EVs in that there was still growth, near 30% increase in EV sales. However, 2024, it's expected that EV sales will grow by less than 30%. Closer, the estimates are for growth of around 26% for 2024. Combined with the fact that production is going to meaningfully increase, likely much more than the 28% increase in EV demand, that's going to put further pressure on EV sales in 2024. That's for Tesla included. The flip side of that is that the Federal Reserve in the United States has suggested that it will cut interest rates roughly 3 times this year for a total of 75 basis points. Lower interest rates could increase demand for EVs because most car purchases are financed with debt, and if your debt payment is low, your debt interest rate is lower, your total monthly car payment will be lower. So that's going to be on the positive side for Tesla, and then on the downside is the supply and demand imbalance, notably supply increasing much faster than demand is increasing. So it's an interesting scenario Tesla finds itself in, but this news out today for the wage increase, in my opinion, should not have caused the stock price to fall by 3%, especially because we don't have details on how much the wage increases are. So I think this drop is an overreaction. But then again, Tesla's stock is seemingly always overreacting, both to the upside and to the downside. It just moves. It's just an extra volatile stock, and it's doing what it typically does, react with more reaction than was perhaps warranted, but still reacting nonetheless. So remains to be seen. We'll follow up with you on what this could mean further when we get more details. And of course, as usual, I will update you when any new information comes out. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.